Good morning from our New York City studio. My name is Gad Lebanon. I'm Chief Economist North America here at the Conference Board. And welcome to our first 2018 Economics Watch webcast, and Happy New Year. We have a special webcast here with the power team here alongside me that I'll introduce in a minute. Let's start with what we're going to talk about today. So we're going to answer some critical questions and issues. One is overall the momentum is pretty strong in the US and the global economy, but what are some of the main risks that we are likely to face? The second is, as you all know, there was a big tax legislation passed Congress last month. What are the implications for consumption, investment, and overall economic activity in 2018? And we'll also release or talk today about our new C-Suite Challenge report that is about to come out when?
Next week.
Next week. So we'll get a sneak peek of the main results there. And so we are headed to a very interesting hour. Before I introduce my colleagues, I'll just give you a few webcast tips. If you have any questions, don't wait until the end. You can type them in the chat box at the bottom left of your screen, and we'll take them as they come. If you want to download the presentation, you can do it via the file download pod at the bottom center of your screen. You can view the video or the PowerPoint at full screen by clicking the 4 arrows at the top right of your screen. Now, if you have a minute at the end of the webcast, we'll appreciate if you can complete a brief evaluation so we can make our future webcasts even better. And if you want to watch this webcast again or share it with colleagues, it will be available approximately 48 hours after the webcast on our website. Also, if you're interested in CPE credits, they are available for this webcast. You need to type your full name and email address at the space provided and click OK for 3 pop-ups that will occur during the program. You need to stay online for the entire webcast to get the CPE credit, and it's only available for live webcast only. So who do we have here with us today? So first, on my right, our Chief Economist, Bart Van Ark. Good to have you back.
Nice to be here. Yep.
And next to him, Chuck Mitchell, Executive Director, Knowledge, Content, and Quality at the Conference Board, and also the main author of the C-Suite Challenge that we're going to talk about in the second half of this program.
Yep. Well, thanks a lot. Thank you.
And as usual, a regular here, Brian Shaitkin, Senior Economist. Welcome back, Brian.
Thank you, Gad. Happy to be joining you now in 2018.
Yeah, Happy New Year, everyone.
That's also true.
So we'll start the way we will start with the global economy. We'll then move to the US economy, and then we'll move in the second half of our webcast to the C-Suite Challenge. So Bart, you want to take us through the global economy section?
I think you first have a poll question that you're going to ask.
A poll question, that's correct. Let's let the studio load it. So the question is, what is the biggest risk that could cause global growth to slow in 2018? There are 4 options here. One is international conflict, i.e. North Korea, newly erected trade barriers, rising inflation forces the hand of central bankers, pushing up capital costs and interest rate, fall in equity or asset prices. So I'll give you a few more seconds to contemplate the answers. 5, 4, 3, 2, 1, and let's close the, okay. So, interesting results. As opposed to some of the articles that we've been reading in the newspapers, none of you is concerned about the fall in equity or asset prices. That's interesting. The large majority is mostly worried about new erected trade barriers. And then some of you are also worried about international conflict and the rising inflation and interest rates. So very interesting results. Any thoughts from our panel here? Brian, you want to?
So I think I'm somewhat more skeptical than our audience about the chances of new trade barriers playing a major role in shaping the 2018 outlook, simply because as long as the economy is strong, the current US administration at least seems to value well-performing equity prices to a great extent, and I think there would be a reluctance to disrupt that kind of momentum, and potential new trade barriers could do that. And I think when I look at equity prices, the bottom line is they are very, very high by any historic metric that you use. And when those prices are high, we can't quite point to the reasons why they might come down, but there is historically a substantial chance that they will. So I think that's definitely something that people should keep in mind in an otherwise rosy economic environment.
Good. I think the international trade barriers, that kind of reflects, we're probably getting a little ahead of ourselves here, but reflects some concerns that we see in the C-suite challenge for sure. Something that over the course of the years has really risen this year, it comes to the top. And when it comes to equity prices, are we back into the irrational exuberance notion? So that's one question I would have.
Right. Well, I was also surprised that the trade barriers got the majority of the votes, more than half out of the 4 options. So that certainly tells me that I should think more seriously about it. Bart, any?
Sure. Well, let me hold on answering my view on the question. Let me first start with sort of giving a quick overview of the global economy, and particularly the good news, and then we'll end up with some of the risks that many of you have been identifying, and that we also identified as potential risks. The question is, what is the probability of the impact? So, as you know, we always like to sort of look at the numbers and see what's going on, and look a little bit back over time. This chart is the black line is looking at the growth rate of GDP globally in the global economy. And then the blue line is our new global leading economic index. It's basically an aggregation of our 13 leading economic indexes that we do for the largest economies around the world. And you can see that usually the LEI is leading better performance in GDP growth. That is a pretty strong indicator here. And when we then look at the latest developments, we didn't see it that much in sort of 13 and 14 when the LEI also picked up. But now we see the LEI making a really good pickup globally, and I think that really gives us good news, not only about current conditions, but also for the conditions that we're looking at in the next 6 months. So we would say that basically from an economic point of view, looking at the economic indicators, we are in extraordinarily good shape for starting a very strong 2018, and in that respect, the sort of risks on the economic side, for the time being, these are relatively limited. You should, of course, realize that these leading economic indexes give us an outlook for about 6 months, and beyond that, we are much more in uncharted territory. When we break up our global leading economic index into the one between emerging economies, which is the gray or blackish line here, and the mature economies, you can see that, of course, emerging markets are still showing more strength in their business cycles, but it's been sort of, the growth has been leveling off a little bit, but emerging markets are doing pretty strongly, a lot of that being led by China. But I think we want to particularly point your attention to the yellow line, which are the mature economies, because that line is particularly strong, even though it's below the global leading economic index. It keeps sort of adding on every month more strength to the business cycle. And I think that is a very important observation. I think when we were talking about this even a year ago, or maybe a year and a half ago, we would not have expected this. We would have expected that mature economies were sort of in the sort of maturing phase of the business cycle, and that these leading economic indexes would gradually begin to level off and potentially even lead to a peak. There is nothing like that in the data yet. It sort of keeps going on a pretty strong basis. And the way you can even see this better is in this slide, where we basically take 3 6-month periods, where we average the global leading economic index, but then look at the contributions of individual regions in the world to that global leading economic index. So first of all, over the past 18 months, you've seen a strengthening of that global leading economic index. You've been seeing that China keeps adding significantly to the global LEI. It's still a major driver of the global economy. But I think more important for now is the fact that both the euro area as well as the United States has increased its contribution to the global leading economic index. So I think that sends an other signal that it is mature economies that are really sort of giving us the positive momentum that we are currently looking at. Now, this slide is a slide that we actually showed 2 months ago when we did our global economic outlook for 2018. But what we did in this slide is that the red observations here is sort of what we think is happening, has been happening over the last 2 months. So we're looking at sort of how did we think about the global economy in November when we were already talking about this acceleration versus what the current situation is. So in November we talked about the stabilization in energy and commodity prices. Well, if anything, over the last 2 months we have seen those energy and commodity prices actually accelerating and giving us somewhat more upward pressure. For the time being, that's not bad news. It's mainly good news, but of course it depends on whether this can continue. Our projection would still be that on the supply side, there's still so much going on in adding more supply that we don't think that this will go through the roof, but the upside pressure is clearly visible. Consumer growth has been very strong. If anything, the consumer confidence indexes of the past few months, certainly also in the United States, but also in the euro area, keep being strong. So we see continued strength there. The recovery in Europe, the quarter four numbers that are beginning to come in now for the euro area are very strong. So we basically say we're kind of storming into a stronger 2018 for the euro area. The pickup in investment that we saw starting in sort of second quarter of last year got even stronger in quarter three and potentially, as the numbers look like now, also in quarter four. The anticipation of the tax plan that we'll talk about in a minute might even have added a little bit to that. And then there is China. In China, we do actually project a little bit of a slowdown, both in real estate and in investment. But the November numbers, which are the latest numbers we have, are still pretty strong. So we're not kind of worried that China will become a drag in any way. We've been looking at a return to a stronger dollar. There are no signs of that yet. It's one of those puzzles why in this environment with a stronger US economy, more capital flows to the US economy, potential more interest rate increases in 2018, why the dollar doesn't get stronger. We think that upward pressure is still there, but we haven't seen it in the last 2 months. And then I'll come back in a minute to the geo and political economic risks, but I think it's important to say that there are plenty of risks. The question is, what is our probability of any of these risks really turning out into a real event? But I think overall, the conclusion is that, the 3% growth rate that we were looking at for 2018, we might actually end up a little bit better in 2017 and perhaps even so stronger in 2018. And I think if anything, there's an upward pressure on these numbers. We're coming out with revised numbers in February, so tune in next month. But I think it's very likely, unless something happens in the next 4 weeks in terms of the numbers coming in, that we will come out with a somewhat stronger outlook for 2018.
Right. So it seems like there is kind of a virtuous cycle that as things get better, in some parts of the world, other parts of the world are benefiting from it and they feed off each other. I guess one question is, how long can that last?
There's a surprising amount of synchronization at the moment, and in fact we're getting a lot of requests from media also about this. So you see a lot of stories about it in the newspaper already, but certainly also in the coming weeks. And I think in a way, sometimes you have this positive momentum in the economy when stronger business confidence is leading to a stronger sentiment of the global economy, and it's kind of feeding on each other. And even the tax plan in the United States, we'll talk about it in a minute, but I think the overall sentiment in the rest of the world is okay. It may cause some capital outflows to the United States and may lead to some adjustments. But as long as these economies themselves remain relatively strong, they're more likely to perhaps even benefit from this rather than suffer, because a stronger US economy is good pretty much for the rest of the world. So I think that is one element of synchronization. And also, I think, a lot of these economies are still, I think we're still in the aftermath of this 2008-2009 recession. We're finally seeing a pretty much across the board recovery that is ongoing. How long? Well, that really gets to, I think, the question of the risk. So let me wrap up there and then continue. The risks that were identified in the first question, you see some of them back here. But as I said, I think a lot of these risks that we're talking about are very high impact risks. If anything of this is going to happen, it could be really bad and it could completely change the picture. But the probability of it is pretty low. We've been doing an exercise within our own team in the last week, talking about, which of the events do we think has a higher than 25% probability. And I think we frankly have a hard time to come up with anything that we think, might very likely happen. And therefore you cannot really sort of include it in your forecast. You can only be aware and conscious of these things. So, about a quarter of you mentioned that, we could see an unanticipated acceleration in inflation and wages. That could happen as the US economy is going to strengthen. That would cause faster response by the Fed. That would make other central banks, which are still much more overexposed to liquidity, into bad shape. But again, if we're looking at the inflation numbers, something has to happen very, very big in the next few months to suddenly see wages going up and prices go up and so on. None of you actually identified the risk of the financial markets being in serious issues. We might see anything of a correction up to 5%, but that is probably not going to trigger a major crisis. The question is really, you could see something explode. We're now talking about Bitcoin. You could talk about tech valuations. You can talk about capital flows to the US, which are not a good sign of a stronger US economy, but just a flight to safety. Some of these events could give us that risk. China, it's all about confidence. As long as we believe that China is going to be one of the strongest economies in the world, we're willing to go along with their extraordinary high debt situation and a pretty weak private sector relative to the state-owned sector of the economy. And then the ones that has been identified most by those on the call are all these, what I would call geopolitical wildcards. And again, any of this, even the trade disruption, I would agree with your assessment earlier. It's very likely, in my view, that a lot of these trade conflicts that are going on now will sort of, evolve into some kind of compromise or whatever, and things will kind of move along. So I think a lot of this has less than 25% probability. But you can ask the question differently, and that is, how much probability would you give it that any of these events could happen over the next year? And would we still say that it is 25%? In other words, there's so much stuff. It's hard to believe that nothing would go wrong in the coming year, and then the question is what the impact is going to be. But I would wrap up basically by also focusing on the upside. We could be too low. And I think there are two reasons why we could potentially be too low. One is that the US tax plan could have a much bigger impact than we're going to talk about in a minute. We're talking about some positive impact, but it could be a lot more than we're currently looking at, and the rest of the global economy could benefit from that if the US economy becomes significantly stronger. And then finally, even though it's a medium-term effect, but medium-term will become short-term at some point, it could be that digitization is actually going to kick in bigger in 2018 than we are anticipating. We do see some productivity numbers which are getting somewhat stronger in the United States. Our outlook for productivity globally is somewhat better. So it could be that we're actually beginning to see a little bit of a tipping point here. Now, again, a lot of this is a little bit more guesswork, but I think there is as much chance that we could actually see an upside in the global economy than a downside.
Yeah. Now, if we can go back for a second to the main answer that our audience gave about the trade barriers. I found it a little surprising, but I think it does represent a fear that our members have about major disruptions there. I guess my thoughts on that are that so far the administration seems to be care more about near-term growth rates than about keeping all their pre-election promises. And I think I would be surprised if the administration would significantly disturb the current growth rate to achieve some new trade agreements or disrupt them. So I think it's not a very high probability development.
I think to that point, it very much so that the campaign promises were around jobs and getting jobs back. And when you look at the unemployment rate, that urgency to some extent starts to dissipate.
Yeah.
So
I think that's a very good point. I mean, it depends on who's going to claim the credit for a good economy. We can debate that. But as long as the economy remains strong, the risk of an administration taking unprecedented, unproductive policy measures, I think that risk is actually going down somewhat compared to a much weaker economy that we're not really seeing at this point.
Right. Great. So I think we're moving to the US part, but before we talk about it, we want to hear some of what our audience thinks. So we have another polling question here. How much time has your business spent looking at a new tax law during the past months? So there are several options here, and also tell us about your vacation. Every waking hour, enough time to substantially change key strategic decisions, enough time to know that our business practice will change modestly, waiting for our lawyers to report back, passage in no way interrupted holiday vacation plans. So you probably need time to remember what you did in the past month, so let's give you a few more seconds.
Well, if it was every waking hour, you will remember it.
Maybe they're not watching this webcast if the answer is every waking hour.
Yeah. So 5, 4, 3, 2, 1, and we'll close it. So nobody spent every minute thinking about that, and it seems that also very few already reached conclusions that this will be a major disruption. It's more, if I interpret it, it was more wait and see, let's learn more about it, let's let the lawyers get back to us, rather than already during the vacation, interrupt our vacations and change course.
Well, I think what is very important to remember here, as I mentioned earlier, and you'll talk about a little bit more for the US outlook, is that the US economy was already getting stronger. I think businesses have been seeing a strengthening in investment in the past couple of months. This will help one way or another, but it is not a make or break. It is perhaps a welcome other tailwind, hopefully, but we'll talk about that. But I think one of the reasons is that, we've already been seeing the strengthening economy. So why would you stay up every hour at the moment to see how this is going to play out?
Right. So to talk a little more about the tax plans, Brian, you want to take us through some of that portion?
Okay, so let me first start out. How do we think about the current state of the U.S. economy, and what is the role of the tax plan in reshaping that vision? So first of all, it's important to note that we're in the midst of this global synchronized expansion at a very fast rate. We're achieving nearly 3% global growth. We expect a similar rate in the US. We're projecting 2.9% in the US for next year. Over the next 2 years, individual tax cuts will come into effect. That's going to help boost consumer spending. In addition to that, businesses are immediately going to benefit from lower rates, as well as the opportunity to fully expense certain kinds of investment. The Federal Reserve so far has responded not by anticipating that they have not anticipated that there would be a lot of upward pressure on inflation, even though the economy may grow somewhat faster. There may be more demands on capital and labor. All of this we would suspect, be inflationary. But so far, the Federal Reserve has not announced an intent to raise interest rates at a faster pace. We anticipate 3 rate rises this year and 3 next year. So as a result, the price of capital is not going to rise all that quickly. It's important to note, though, that if fiscal stimulus measures of this scale were going into effect during an economic downturn, they would have a larger immediate growth effect when there's lots of spare labor and capital resources out there waiting to be employed, as compared with right now, when unemployment has reached a long-term low, when we're not seeing what we saw in 2016, where there was a lack of investment. During the last 3 quarters, we've seen a clear pickup in capital spending. And so what we're witnessing right now is probably the strongest business environment in the last 10 years. And so far, I think it's important to recognize how the global environment is supporting that that one of the reasons why capital costs have been contained and the dollar hasn't yet appreciated is that the global economy is strong. And so as a result, there's a lot of demand for dollars, but there's a lot of demand for other currencies as well. So that's keeping down interest rates and preventing capital costs from rising. So what are some of the key features of this tax plan? How do they affect both consumption and investment? So first of all, very simple, you have lower marginal income tax rates for individuals. The bulk of these benefits are going to go to higher earning individuals. They have lower propensity to consume, but still their propensity to consume, according to San Francisco Fed research, is about 60%, higher income individuals, but their propensity to consume is still about 60% of lower income individuals' propensity to consume. Pass-through businesses, and this is going to be another impact on consumption, those businesses who are not organized as C corporations, but instead receive income every year through their businesses, they're going to have the right to deduct a substantial share of their income. So that's also going to add to consumption activity for some small and large business organization owners. It's important to note that this is one aspect where there's some uncertainty about exactly what the fiscal and budgetary impact is going to be, simply because there's a large amount of dispute as to exactly who can be classified under this new pass-through status and who isn't. So that's going to add some uncertainty to the amount of revenue that's going to be collected. Another area for uncertainty is this question of what's going to happen as a result of the way in which mortgage interest deductions are changing and how is that going to affect the housing market. We suspect that's going to hit most on highly expensive houses, those above $750,000, because the deduction is going to be limited to $750,000, and then at the same time, those at the lower end who, because their standard deductions are going to rise, that's also going to reduce their housing values. So that's going to have a countervailing impact on consumption. We suspect that may cause house prices to fall by about 4%. For corporations, not only are they getting lower rates, but they're also getting immediate expensing, that right to write down investment costs right away. And so that's going to play a role in raising investment, especially with regard to, as I'll get into in a moment, structures, because the depreciation length on structures is longer. And then finally, in terms of thinking about the tax plan, $2.6 trillion is going to be repatriated from overseas. And so that's going to result in some additional consumption activity in the form of, to the extent that is used as dividends and as money to do share buybacks. That can result in some additional investment activity and also fund some mergers and acquisitions. So those are some key things in terms of thinking about how the tax plan influences the outlook.
Thanks, Brian. And as you all know, we can spend an entire webcast on this tax plan. And in fact, next month, we are going to spend an entire webcast on that. But to make sure that we have enough time for Chuck to talk about the C-suite challenge, let me skip a couple of slides. I think, Brian, that one of the implications of the tax plan is summarized in one number is what will happen to disposable personal income.
So we're projecting that disposable personal income for the first quarter of next year is going to rise to around 6.7% from around 2.5% the previous quarter. At that point, there's going to be more normal growth in terms of disposable personal income, but we think that you're going to see an impact on consumption of about 0.3% in GDP. Now, an important point about thinking about the impact on consumption is that in this chart, the blue line, which shows the growth of personal consumption, that has been growing faster than the red line, disposable personal income. So people are spending more than they're earning right now. Their growth of spending is exceeding their growth of earnings. So just because earnings come up doesn't mean that they're going to be spending all of that additional earnings. Now, one upside to consumption potentially to take it beyond 3% would be if wage growth increased, giving people even more income. And we'll see if tight labor markets can create that kind of environment in 2018.
Right, and speaking of the labor market, as you see in the blue line here, this is the U.S. Unemployment rate. It's already at 4.1%, which is the lowest since the year 2001. Given that we raised our forecast for the U.S. economy for 2018, and we expect the economy to grow at the rate that is probably double or even more than double the rate that is needed to continue to tighten the labor market. We're expecting the labor market to further tighten in 2018 to the point that towards the end of the year we will reach an unemployment rate that is the lowest since the 1960s. So one implication of this stronger economic growth is further tightening in the labor market that we expect to push the wage growth further higher. As you can see, there are two wage measures here that didn't show further acceleration in 2017, but with a tighter labor market, we think that it will eventually lead to faster wage growth, especially since we are seeing some signs that productivity growth is accelerating, which is another important determinant of wage growth. And in recent months, we're getting pretty good indicators that the momentum is very strong, right?
Absolutely. So what this chart shows is that we're seeing continued increase in that blue line, in the green line, which is new orders of non-defense capital goods. So that's an important measure of investment. You can see that the red and blue lines, two measures of business confidence, including our own measure of CEO confidence, those are both at very high levels. I think another important point is that this tax plan is going to change how businesses end up spending their money. What this chart shows is the reduction in cost anticipated for various types of investments. So you have equipment and structures compared, and you can see that for structures, because of that long depreciation time, that's going to result in a larger decline in capital costs. And I think a key question trying to think about how does this plan change the growth environment is whether more spending on structures as opposed to intangible capital is the direction we want to go in. I mean, there are certainly elements of structure spending, warehouses, data centers that are critical to future digitization related growth, but at the same time, there is that need for more R&D, more intangible capital spending. And so I think a big question regarding this tax plan is whether it's designed in such a way that it aligns business spending with the types of activities that are most consistent with enhancing future productivity.
Right. And so there's a lot of still open questions about the impact of the tax plan that we'll touch on in next month. By then, we'll also know much more about the initial impact. One thing that we haven't seen so far is a strengthening of the dollar as a result of that.
Right. And what's surprising about that is if we were expecting massive capital inflows, that would increase the demand for dollars and as a result, increase the price for dollars. But in 2017, the dollar was depreciating, the dollar shown in that green line in this chart, and we haven't seen a countervailing appreciation yet, in part because global activity is so strong. So even though there are great opportunities to invest in the US, there are also great opportunities to invest in Europe, China, and elsewhere. And so for right now, the dollar is not getting more expensive, and so that may actually cause the impact of the tax plan to be slightly greater simply because an appreciation in the dollar would result in a loss of US sales, a loss of export competitiveness. And for right now, we don't see that happening.
Right. And what is happening is a very strong growth in stock prices. That's the red line here, breaking new records every day. But according to the earlier poll that we took, the majority or none of you are especially concerned about that. There are some reasons for it to continue growing. Simply lower corporate taxes means that more is staying at the company, and that by itself technically should be a significant boost to stock prices. So it's very hard to tell how much of the increase is a euphoria and how much of it is based on real fundamentals. But the real fundamentals did improve. We can say that. So let's conclude the US part with a regular forecast table. I think if you look at the top line, just to give you the bottom line at the top line, if you look at 2018 and all the way to the right, you see the annual growth rate. So essentially the biggest change that we made to our forecast in recent months is we raised the 2018 number that is now at 2.9%. Part of it was because of the tax plan, but part of it was already signs of a strengthening momentum in the months prior to that.
So let me ask you a question, both Brian and yourself, Gad. For the first time since probably 4 or 5 years, we find ourselves at the higher end of the range of forecast for the US economy. And I think it served us well for many years to be at the lower end. That was right. We now move to the higher end.
You mean, when you say higher end, you mean compared to other forecasts?
Compared to other forecasts, the range of forecasts that are available. So I think the question to you is, what is it compared to other forecasters that actually is pushing us up? Is that the tax plan? Is it because we've seen more acceleration in the US economy than other forecasters have done? Is it because we think there's more strengthening in disposable income and consumption, some of the things that you talked about, Brian? Where would you put the emphasis?
Well, my answer would be that, and I would like to think that we are more nimble than some of the other forecasters that tend to be more cautious in changing their forecast dramatically. And we did change our forecast. We were at the middle of 2017. We were at 2.1%, I think, for 2018. And you know, we looked at the data. We concluded that the momentum has changed. Something really changed in the U.S. and the global economy. So I think we just reacted to that. Now, looking at the last 3 quarters that were growing at about 3% on average, and with the tax plan providing additional boost, we just don't think that there is a reason for a major slowdown in the economy. So I think that's why we are above consensus. Now, we do think that eventually the trend of the US economy is about 2%, so we can't be in this elevated rates for indefinitely. So we already, in our 2019 forecast, we are predicting a gradual return to normal, but still at above trend rate.
Okay. Yeah, I mean, I think global synchronization is a huge factor. I think it's something that, to Gad's credit, he identified earliest in our monthly forecast meetings. And I think that's a key element that plays really well with this tax plan, because it means that rather than lots of capital flowing into the US and that resulting in a loss of export competitiveness, you're not seeing that yet. You're not seeing as much pressure on the Federal Reserve to boost interest rates, and that those factors are conspiring to create the type of growth environment that we're seeing so far in 2018. We'll see how long that synchronization can be maintained.
And that's the comment of the timing of your comment is excellent, because the performance reviews time is now. So this is right in the right time. So any other comments on the U.S. global economy? Should we? Okay, we'll move to the C-suite challenge. So Chuck, this is one of our major reports at the conference board. Great news every year. So what's new?
Well, what is new? The sentiment, to sum it up really quickly, is as positive as the numbers that we've just been talking about are. That there's a real optimism there, and again, it's if you want to call it synchronization in pretty much all the global regions. But we'll get to that a little bit. Just a short background on CEO Challenge, C-Suite Challenge. This year we did expand it from a CEO Challenge to include really the full C-Suite, 21 functional titles. It kind of helps us get a broader perspective on the organization and some of the connects, disconnects, alignments within those organizations. It's a pretty simple survey. We present 6 business challenges. Then we ask the respondents to rate the strategies that they're going to go to meet those challenges. We also ask them about what we call hot button issues, the short-term tactical things that they feel are really going to have an impact on their organization in the coming year. This year we had over 1,100 responses. We had some great partners globally that helped us carry this out. Now the key insights, when you look at the strategies, when you look at the hot button responses and some of the additional research and conversations with our councils, we really kind of come down to these key aspects of the data in the report. And again, just kind of following what we've been talking about, that the notion of global recession has really receded in their minds. Last year in 2017, it was the #1 hot button issues for CEOs across, especially in emerging markets. Particularly in emerging markets. And this year we've really seen that fade away. The other thing that we can't escape is that the political realities in Washington with the new administration have really driven a unique set of concerns for U.S. CEOs. That the notion of a tight labor market has really had organizations looking at alternatives. And when we talk about that, we're looking at non-traditional labor forces, we're looking at contingent labor forces, we're looking at automation. One thing I would want to note, though, on this is that recognition of the tight labor market and the need for outside solutions, but when you look at the notion of wage inflation as an issue among CEOs, it doesn't surface. And we feel that that's still a disconnect. It's something that's going to hit them over the head maybe a little bit down the road. What we're talking about. And the notion of digital transformation. There's a lot of issues that they come up with the notion of digital transformation. Not the least are our unique set of risk and opportunities, but also the notion behind leadership and what kind of leadership do organizations need for a digital future? What are the traits that are there that are going to be required? And they're really looking at leaders that are adaptable, engaging, and inspiring, and probably most important, strategic thinkers. So it's really that long-term vision. That notion of innovation too, obviously a critical issue, and CEOs and C-suite executives alike really see innovation not so much as a technology issue, but very much as a cultural issue. But one of the notions that really surfaces is that measuring innovation is really a problematic gap for most organizations. It's really an issue. And then there's the notion of agility and flexibility, which CEOs and C-suite executives really select as key strategies, and not only in their operational side, but also in the risk mitigation side. And so we went and asked them what they thought. How do you define an agile organization? And it's really interesting. It's about effective change leadership. It's about the individual employee being resilient and adaptable to change. And the human resources side providing those individuals with the tools to do that. But what I found kind of interesting too was the notion that supporting the agility and flexibility is big data, and that we found pretty interesting, an interesting notion.
Right. And before we tell you all the results, we thought we'll ask you to predict some of the questions that we asked the CEOs. So let's look at our last poll question. So there are a lot of options here, so I'll give you more time on this one. What do you see as the most critical challenge to your organization in the coming year? So the first one is failure to attract, retain top talent, creating new business models because of disruptive technologies, volatility in cash flows, new competitors globally, developing next generation leaders, and cybersecurity. So again, 6 questions. I'll let you think about that for a few more seconds. So 5, 4, 3, 2, 1, 0. Let's close the thing. So interesting results and interesting distribution here. So the number one concern or challenge is the creating new business models because of disruptive technologies. Maybe we could have called it the Amazon effect. The second largest, with about close to a third, is the failure to attract, retain top talent. There are also a few that chose developing next generation leaders, and very few or none to the 3 options: the cybersecurity, volatility in cash flow, and new competitors globally. That's interesting that nobody chose new competitors globally. I think with the emergence of large companies in emerging countries, I thought some would choose that, but no. So any
Maybe we'll just review what the CEO said.
Right, and that's it does kind of pretty closely track, as we say. The CEOs on a global basis and pretty much across all regions look at that notion of attracting and retaining talent as the big issue, but also the new business models, and that really comes down to the impact of digital transformation and. We put it very much as coordinate that or associate that with new competitors globally too. That's all part of the lower barriers to entry as they come and go in the digital transformation space. That's forcing that creation of new business models because of those disruptive technologies. So we're kind of tracking, tracking the CEOs as you would say, in the rankings. And the next generation leaders too is kind of an interesting notion because that too, in many ways, we associate with digital transformation and the new digital economy. It's an issue that's going to be confronted coming down the road, and cybersecurity obviously is all part of it. Part of that digital transformation.
I think, Chuck, the one before you go further down the list, the new competitors globally, which get observed as not being identified by this group as being very important. When you look at the distribution across regions, it's number 1 in Europe. And I think that's kind of very striking. I mean, I really always like this geographical distinction. The US, where, a lot of businesses, the openness of the US economy is just less, whereas, European economies are generally much smaller and much more open to the rest of the world. So there you can see the pressure from new competition in the rest of the world being much bigger. And I think that's really leading to the fact that this is much higher, whereas in the US it's just about 7. So I found that an interesting distinction here.
So European leaders find themselves more vulnerable than US CEOs.
Much more dependent on trade to Asia, for example, than is true for most US companies, of course.
Well, it would be interesting to see if that question were broken out into new regional competitors and new global competitors, how different the European responses would be.
Yeah, that's true. But yeah.
It's interesting because of the notion of the new business models, although still relatively high in Europe, but in relative terms, it's a lower ranking than anywhere else. So that competitive squeeze is not being felt on the continent to such an extent.
Yep.
I think one of the other we look at which was ranked 8th globally, and that's the threats to global trade systems. And then when we look at it, it's really felt more at this point in time in the developing world, in emerging markets, in China in particular. But it's still very much on their radar system. Last year, it was near very much the bottom of the list. I think it was 17 out of 26 hot button issues, and this year it's really it has risen up the ranks. So it's a reality in the minds of CEOs and C-suite executives for sure. Mm-hmm. Definitely so. No one picked in the poll volatility and cash flow. So that's the one thing that kind of undermines a little bit of that optimism that we see, that there's maybe a little bit of a concern about.
So what does the volatility and cash flows exactly refer to? I think it was not just CFOs who responded to that, but also CEOs.
Right.
So what do you think is explanation for that concern about volatility and cash flows? Go ahead.
Yeah, no, I think it has to do to some extent with a longer term confidence in the way the economy is playing out. Concern about rising debt on a consumer side as well. That there's just without looking at the data, knowing what the payment times are and that sort of thing. To me, it's the one kind of outlier that shows up there that kind of goes back to, well, maybe we're not 100% convinced that this is all on.
Yeah.
There's some outliers too, right? On the next slide.
Yeah,
which I thought was interesting.
Right, very much so. And we were talking earlier about the unique set of concerns in the United States brought on by the legislative agenda in Washington. Very much on the minds of U.S. CEOs is this notion of erosion or declining trust in political and policy institutions. Not a concern elsewhere so much in the globe, but certainly among U.S. CEOs it is. The notion of the healthcare and tax reform policies, obviously a concern more so in the U.S., less of an impact. But when you look at the regional effects too, I guess one of the things when you look at those hot button issues overall is that CEOs are. What we'd seen in previous surveys was this concern about the sort of global geopolitical situation. To some extent, that's receded into things that within the organizations they can fix, they can control. Controlling the controllable, if you will, within the organizations.
I actually think that is a critical difference with last year. I mean, last year, I would say when we look at this list of concerns in the previous slide, I would say that CEOs are concerned about the good stuff. They're concerned about the things they can control and they can do something about. Deal with talent, try to deal with your competitors. It's not easy, but it's something that's within the controllable. Whereas some of these geopolitical risks that we discussed earlier, which are a threat to the economy, CEOs have actually sort of pushed that a little bit to the background and say, well, let's get focused on the things we can really do something about. And I think that is actually providing a positive dynamic to growth.
Yeah.
That they work on the stuff that I really can do something about.
Yeah, and I think that's reflected when we look at this chart. Just shows the top 5 strategies that CEOs have selected to meet the 6 business challenges we posed in the survey. And when you look at it in its totality, I mean, what it really shows an emphasis on culture building and that notion of the importance of culture to change, to be agile. To meet changing circumstances. It's very much in CEOs' minds about communication. Effectively, it's about inclusiveness. Certainly on the innovation side, and it's about agility and flexibility. When you look at the operational excellence side and the risk mitigation side, that notion of agility really comes to the fore in this, and it's very much about an inclusive, developing an inclusive culture within, and a lot about employee engagement, and that engagement comes through communication. So when we talked about the alternative strategies or notions that organizations are looking at in a tight labor market. We asked CHROs, that's Chief Human Resource Officers, what their notions were when it comes to ways in the next 3 to 5 years, what the structure of their workforce is going to look like. And an overwhelming majority believe that obviously it's going to look different than it does today in 3 to 5 years. And that's really going to be driven by a percentage, a big increase in the number of contingent workforces and freelancers. That gig economy, the Hollywood effect, the project effect within organizations. I mean, digital transformation is really having an impact on the way work is done within these organizations. They see a significant growth in the notion of automation and robotic process automation. These are solutions that start to get at A, part of the wage issues that are surfacing from a tighter labor market, and B, just the demographics, the numbers, how they see that's going to fill the work.
But this is interesting because in a way, what we're seeing here, that on the one hand, CHROs are saying, well, I don't really see that my overall workforce is going to change much. But on the margin, there's an incredible amount of change. And I think this goes back to the disruption thing that you were talking about. I mean, there is this tension between, on the one hand, well, at the aggregate level, it doesn't really make a lot of difference, but on the margin, it does. The question, of course, is, disruption one of the characteristics of disruption is it happens very suddenly, and it can completely upset your labor force. So I think the question is, what are the things that you need to look out for to actually see that top left bullet point to actually change and become more blue, as people see that it has a much bigger impact on their entire workforce?
And just to add to Bart's question, I think disruption often occurs not just suddenly, but around times of recession. So I think it's key to think about, in this present economic environment where we think the chances of recession are relatively low, what would happen to your business right now? What would happen to your workforce? And how would that change in the event the economy was to enter recession?
That's an interesting point. But I think just taking the overall theme or optimism that pervades not only the CEO responses but the C-suite responses and throughout the survey, that we're looking at a point in time here, right? And obviously that there are plans, there are scenarios out there that where organizations are looking at that. But right at this point in time, its focus is on growth. I mean, when we saw last year, we saw a lot of emphasis on defensive strategies within organizations. Things like capital reserve, things like a focus on baseline costs, basic costs. That has receded tremendously in this year. So it's focus on growth, and the biggest barrier to growth that organizations are going to have is their ability to attract quality talent. And we're seeing these as maybe strategies to kind of mitigate that. And one of the questions that's not shown here is a large minority of CHROs believe that their future workforce is not going to be composed of full-time employees, but it's going to be contingent, non-traditional employees.
It's good because we're going to have a large report on contingent workers in the coming year, so it fits with the trend here.
So this is just a quick notion of what it's. Geez, if you can find, if you go to the contingent workforce, your problem is not solved. I mean, here's the notion of what the primary concerns that CEOs and CHROs see. Well, a skill shortage is a skill shortage. It's finding the workers themselves. But what we find really interesting is that notion of the engagement and retention, not only of the non-traditional contingent workforce, but when you look at the engagement and retention of traditional full-time employees, right? So what you're getting is a concern over the tension between the two. They have different badges, different labels, different privileges, different benefits, and one, you make one happy, sometimes you make the other unhappy. It's not necessarily a zero-sum game, but it's that tension, and there's a lot of concern about that tension in organizations. Just to quickly run through the innovation strategies, and it's interesting to contrast the CEO view versus the human resources view. The CEO view, again, as I talked about earlier, it's about culture. It's an emphasis on culture. But when you look at that notion from the CHRO view of this, that it's really about inclusion within the innovation process, right? So you have things like managers who promote ideas in teams. You have the notion of more diversity and inclusion on project teams. And our research has shown that the more inclusive an organization is, the more highly innovative it is. So it's really that a notion of inclusion is really an important and critical driver of innovation, and you can see that emphasis on the CEO side, but especially on the human resources side, where they're really looking to develop that culture of inclusion.
Chuck, before we finish with the CEO C-suite challenge, so next, can you tell us when it will come out and what will come out, so our members can? There is tons of stuff here that how can members reach it?
Yes, indeed. Yeah, the report is out. We're out next week with the full report that looks at not only what we presented here. This is really kind of top line, but we get into some more granular. There's a lot of interesting notions on special questions about innovation outcomes, innovation obstacles. But that will all be out and available on our website by next week.
And I think our Human Capital Watch, which is another monthly series, is also going to address it, I think, next month, right?
That's right.
More on a human capital perspective.
That's on the 17th.
Correct.
Great. So there's a lot more to learn about that. So we are about out of time. So I'll just before we conclude, I want to remind you that we will be here again the next month and the months after that, and every month with our Economics Watch series, and in also a few special events. There is a publication that is about to come out, Beyond the Tipping Point, how the U.S. withdrawal from the Paris Agreement may or may not affect short and medium term.
It's out already. Yep.
It's already out
on our website. Mm-hmm.
And as we mentioned several times during this webcast, next month on February 28th, there will be a special window on the U.S. Tax plan. I believe Bart will be there and Brian, and other experts. By then we'll know much more about the tax plan and we can educate you about the potential implications. So we're out of time. I want to thank you for joining us today. I want to thank our panel for, I think, a great webcast. And if you have a minute to give us some feedback, don't take my word for it. And you can complete a brief evaluation now. Thank you very much and have a good rest of the day.